Hi! Last week we have discussed the business of an investment bank. In this week, we will be reviewing the history and regulation of this industry. The history of investment banks can be dated back to the early 17th century. The Dutch East India Company was the first company to get listed on a formal securities exchange and raise money by selling stocks and bonds to public investors. In the U.S., early form of underwriting services emerged in the early days during the founding of the United States. When George Washington took office in 1789, the federal government had incurred $27 million in debt, and the states had debt totaling $25 million. Alexander Hamilton, the first U.S. Secretary of the Treasury, persuaded the Congress and President Washington to issue bonds to finance its debt obligations. Investment bankers played a role in negotiating the terms and conditions of these bonds. After the American Revolutionary War, the underwriting of government bonds grew significantly. These pre-modern investment banking activities were performed by speculators, merchants, and by some commercial banks. Their services were to sell securities to investors. These pre-modern underwriting services secured the offering of securities. During American Civil War, syndicate banking houses sold millions of dollars worth of government bonds to large numbers of individual investors to help finance the war. J. Cook, generally known as the first major investment banker, launched the first mass security selling operations never seen before in history. Thousands of salesmen were employed to sell a total of $830 million worth of government bonds to a wide range of investors. Investment banking business further grew during the late 19th century. The Industrial Revolution creates a huge demand for capital that no individual or firm could afford alone. For example, the post-war development of U.S. railroad network is tremendous. The U.S. railroad industry is the nation's largest employer outside of the agriculture sector. New York banker J.P. Morgan played an important role funding and consolidating the railway network of the U.S. Industrial growth also brought changes to family-owned business with limited resources. In order to expand, the small business owners needed to incorporate and raise funds in the capital markets. This led to the use of investment banking services by an ever-increasing number of companies. A more formal version of investment banking developed to mediate between firms needing capital and individuals desiring to build wealth. Investment banking practices expanded further in early 20th century, and we see the emergence of some big players in the industry. By year 1900, J.P. Morgan was the most important investment banker in the U.S. Another dominant player in railroad finance is Cohn, Liu & Co. Other well-known bankers include Lehman Brothers and Goldman Sachs. In the early days, security underwriting business was largely unregulated. An increasing number of issuers started to take advantage of stock issuance, as funds raised by selling stocks appear to be free money. From year 1926 to 1929, equity issuance jumped from 0.6 billion to 4.4 billion. The rise of stock market looked unstoppable. Due to the lack of supervision, the investment banking industry met its first major crisis in history. The stock market crashed on 28th of November 1929, which is known as the Black Tuesday. This became a critical factor in the emergence of the Great Depression. The crisis is not limited to the capital market, but spread to commercial banking and common people. A key reason was that the U.S. government did not require separation between commercial and investment banks at that time. Depositor money was used to fund the underwriting business of an investment bank. By March 1933, the banking system in the United States had effectively ceased to function. We have learned that prior to the Great Depression, the investment banking industry of the U.S. is characterized with strong demand for security, mixture of investment banking and commercial banking, and lack of federal regulation for the industry in the early days. Among the early forms of industry regulations, there were some self-regulatory industry organizations. For example, the banking industry formed the Investment Bankers Association of America, IBAA, in 1912. IBAA requires non-price discrimination in the sale of securities, regardless of the investor and transaction size. In the same period, some states launched the state-level laws to regulate security issuance activities. These state security laws are called Blue Sky Laws. For example, the first Blue Sky Law was enacted in Kansas in 1911. This law required firms to obtain a permit to issue securities in Kansas state. Between 1911 and 1933, 47 states enacted Blue Sky Laws regulating the issuance of new securities. Okay, thanks for watching. In the next video, we will have a more detailed discussion on the development of several pieces of laws that was important to shape the investment banking industry today.